Hello, welcome back. A subscriber suggested that we take a look at UIPath. This is a stock that Cathie Wood has been buying a lot of, and as usual, she catches a falling knife. And the current stock price is $21, 21.5. I believe she bought at around 47 or so, so the stock has been massively destroyed after she bought. Now, it's a very new IPO, innovation supposedly, RKK, April 21st, 2021. 2.8 thousand employees for the company, and obviously it's a US company. Now let's take a little bit of a closer look at what is going on with the stock news. This is a very useful module here. You will see that the stock plunges 25%, and yeah, it plunges on forecast pretty much, as we can see here. But we don't really care about the earnings, because earnings is about reactions from the street that can be massively overblown, or sometimes they may not even be a factor at all. So they may not even take into account what happened in the earnings. It can be very random in cases. However, what cannot be random is what the company is doing financially, and this is what we care about. You will see here that today the company is down 28%, which is interesting because, again, if we take a look at the this is the 5-year chart, but the company is a new IPO. It actually IPO'd again April 21st, so you can see when it opened up, it was the high was 70 that day, and right now it is actually at around the last one before today was 30, but right now today is actually down 28%, so this would actually be down a little bit more. Okay, that's interesting. Let's take a look at what the company is doing, because we don't really care about the price. We care about the company's financials, because we want to be buying and holding for a long time if that's a good company. It's down 76% though. Yeah, the 1-year high has been 90. That is insane. So, P ratio 21.9, but negative. It means that the company is actually losing money here. It doesn't make any profit, actually loses money. Price to free cash flow ratio also very negative. And outstanding shares, at least the company is not, at least in the last year, is not diluting investors. That's probably the only good thing. Now, there is a little bit of revenue growth, but it's not insane, although it's, I guess it's a 2-year revenue growth, so it is pretty good. And the free cash flow growth over here has grown a little bit, but still in the negative. Now, the gross profit margin of the company is good, but the net income is terrible. The company is not making money. At least they don't have much debt here, and they do have assets to buy to back that up with. Now, the next thing that we are gonna be taking a look at is, of course, we want to be examining the financials in a little bit more detail here. See what exactly is going on with the company. Obviously, we have just like 2 or 3 years here. It's a new IPO again. And you will see here that the net income of the company, which is basically the profit, used to be pretty good in 2021, but the fiscal year 2022 is negative again, and massively negative. And fiscal year is actually the last 12 months, but it's any 12-month period. It's not 2022 as a whole. It's pretty much the 12-month period that is recorded as 2022. The balance sheet of the company is pointing to a company here, and you can very handily see the total assets and total liabilities. Total assets are 2.5 billion, total liabilities are 650 million. So the company is making a total equity of 1.992 in terms of the total equity. You will see that additional paid-in capital is about 3.5 billion, which is basically what is making the company money, and that is stockholders buying shares, pretty much. So it's stockholders that are actually funding the company and not the operations of the company. The cash flow statement is negative here. You will see that the operating activities of the company used to be marginally positive, but now they turned negative again. And the cash flow from operating activities is also negative. The company is investing a little bit. Of course, that's always a good thing to see. But it's a good thing to see when the company is making money. That's important, and not really using shareholders' money. And yeah, a lot of common stock issued here, as you would expect. We examined that earlier, so this is why this is positive. And the company is funding themselves through investors' money, as we already know. And free cash flow used to be positive in 2021, but 2022 is again negative. Now we're going to be examining the stock evaluation tool to discover whether it actually makes any sense to pay anything for this company right now. And at some point I will be giving access to all of you, access to this tool. So you may want to subscribe in order to be around and learn about it. I will be informing you via new videos, and you will be one of the first to actually gain access, and you can pretty much use your own estimates and try all sorts of different companies that you prefer. So the revenue has been increasing, so we have some good increase in revenue here. The net income year-over-year growth has been bad, and the worst thing is the net income margins here, they are negative. And the same thing with the free cash flow margin, it's only the last year that turned positive. So the revenue growth that we can use can be a little bit elevated because we are expecting this company to grow its revenue. So I'm willing to go a little bit, a little bit overconfident here. These are very, very confident numbers for the next 5 years. Yet the problem is that the net income margin is negative, and it has been negative for every year, meaning that the company is not making profit. It's not making money from profit. And so if you buy something that doesn't make company, what is that worth to you? I don't really know, and nobody really does know, because this is a very, very big risk. The company could keep on losing money, and or it could actually, reverse the situation and start making money. But you're buying the company today, and you should be based off of what the company is actually doing today, if you want to have as less risk as possible and also enjoy potential returns that make sense. Because otherwise you're buying a lottery ticket that you don't know what's going to be doing in the future. So here the net income margin is very, very negative. Of course, again, we don't have any positive years. Yet I'm gonna use some positive values here, 10, 15 and 20, supposedly thinking that the company can actually reverse the situation and do much better. Now for the free cash flow margin, we do have a 73% here and a 12%, so I will go 40, 50 and 60. I will be somewhere in between. Now I'm gonna go 15 here because I want the company to make more for me, a higher return, because it's a much, much riskier proposition to own this company. And so I won't go with my usual 13% because I'm making a lot of assumptions here. This is why I want to be going with 15% instead, since I'm taking more risk. Hope that makes sense. And if I hit calculate here, you will see that even with these very, very confident assumptions, we're getting a company that has a high estimates of the max price to pay today at about $6.5, and these are the highest estimates here. So we're talking about a massively overvalued company, and this is why you're looking at these companies that are doing terribly bad as years progress, as time progresses, because the company has lost a lot of its value for a reason. It doesn't really make a lot of money, and the problem is that you can find a lot of companies that lose their value because of the current market conditions, because everything is going down. The difference is that if you're buying a company like let's say Facebook is making tons of money, and so eventually when the situation reverses and we're going back to normal, this company will definitely come back to its normalcy, and its stock price will go normal, and it will be back at where it was and then some. But in this case, we're looking at a company that is losing money, and so it's a very, very risky proposition to hold it, especially when it's going down right now. You are really asking for a lottery ticket, but cheap can get cheaper in the stock market, and you have to be very, very careful here. In fact, I would probably play this company for a short, not really a long hold here. So hopefully that video helps you a little bit, gives you some ideas, and thank you for suggesting it. And don't get overwhelmed by the company stock price being down 76%, and you're thinking that it can go down more. That's not the case. It won't go down more. That's not the case. It can go down more. And also you have to always remember that if a company stock price goes down, let's say to $10, $5, $6, they can always reverse split, and then the company stock price is back at $50, but you're still losing money. So do not get in love with the stock price. It's irrelevant. What is relevant, or even how much the company has lost, that's also irrelevant, unless you are trading the company, in which case it could be relevant if you are willing to catch like a trend. But if we're talking about long-term investing, this should be completely irrelevant to you. It's not about the chart. The chart is only about investing, about trading, and like short-term trading. So hopefully that helps you a little bit and gives you some ideas. And please leave a like if you did like this video. And again, subscribe, because at some point I will give you access to this tool, and trust me, this is a great tool. I mean, I'm using it daily. It can really help with analyzing. And so thank you for watching this one, and I hope you enjoyed it. If you did, take a look at this video that I made a little bit earlier, and it discusses Tilray, a very, very interesting company that a lot of people are willing to potentially take a look at and maybe invest in. So thank you for watching this video, and I'll see you in the next one. Bye bye.